I mean, we grew fast. We've been named the fastest growing real estate company for the last 3 years in a row by Inc. 500. Actually, this year we were ranked as the 4th fastest growing private real estate company in America, but we stepped in the mud. So much money getting ready to go to war and sell storage and buy stuff. It looks pretty bad for the rest of 2023.
It seems like this is a theme with a lot of our guests recently, is it's who, not how.
There is a huge demand for product, and there's not a lot trading. We think that the most value is built from the ground up. If there's no opportunities trading right now, and the interest rates are what they are, how am I even going to find margin?
Were you ever wondering, will this work?
Collaboration beats competition every time. I would say that we're industry leading in communications. A lot of the feedback we get from investors is that you guys are the best communicators. Providing a service or providing an opportunity to provide some liquidity is a game changer. I think every operator who's a syndicator or operating at the non-institutional level, probably wondering the same thing.
Welcome back to another episode of the Syndication Show. My name is Kalani Michelle, and I'm here with my co-host, Christian Sadler. And we have a special guest today, Mr. Ryan Gibson, co-founder of Spartan Investment Group. Ryan, I would love for you to tell our audience a little bit more about you and what you're doing with Spartan Investment Group.
Thanks for having me on. We are a self-storage operator. We're actually now the 40th largest operator of self-storage in the United States. And we provide investors the opportunity to invest alongside of us in all of our investments. And we're in 11 states now. We have about 4 million square feet or 30,000 units under management. And we're based in Golden, Colorado.
Yeah, well, thanks for coming on. We appreciate it. Before we dive into the interview, I would love for Christian just to tell you a little bit more about what PREIshare is up to in the industry.
Yeah, I love that you were able to come on short notice, and it's great to have you here. So with PREIshare, we are raising a fund specifically to support sponsors and passive investors. So we're not out there creating the syndications. We want to go out there and find the best syndicators, and then we want to be allies with them. So essentially with our fund, we have a few different services that we're bringing to the table, one of which is top-off services. You probably know the term, but if you're in a raise and you need those last funds to get the deal done, we can help with that and bring those funds to the table. And then it's kind of a unique model where you can actually backfill us back out and slot some of that money in just like a regular investor. We also have pref equity. And so if you're further along into a transaction and maybe interest rates have changed, or something has happened to where you need more funds and you don't want to do a capital call to your investors, if you're an approved sponsor with PREIshare, you'll have access to the funds to do so. And then what we believe is really going to change the industry is we're creating a listing hub, which is basically like a secondary marketplace for fractional shares inside of a transaction, which gives you more liquidity for your investors, which potentially helps you with your raise. And within the fund, we will be making offers on those fractional interests as well. So we're excited at the opportunity to create that liquidity and give quick access to those investors that maybe have some capital needs, and it doesn't create an issue for you, because the last thing you want to do is go try to backfill a deal that you already have running and operating when you're probably moved on to the next transaction. And then in addition to all of that, Ryan, what we're trying to do is create more transparency within the market. So what we want to do is have these conversations with sponsors, with investors, with industry professionals, talk about what's really going on, have those hard-hitting conversations, and hopefully we get some things from you of some of the, the ups and downs that you've seen within the storage space, because the value that brings to the next guy that's watching this is immense.
That makes sense. Happy to share.
So Ryan, how long have you been in this industry?
Yeah, so we started Spartan Investment Group in 2013. But originally we were a real estate developer in Foundations Capital, Washington, D.C. And we turned brownstones into condo buildings. We also built some new houses and just did some short plots. And quickly realized that it's hard to scale real estate development or single family development, and especially markets like that. And we really wanted to be in an asset that was easy to own, easy to evict, and easy to maintain. And also we wanted to be in something that was uncorrelated with the market. So something that did really well in bad times and really well in good times. So that was our transition to self-storage. Scott Lewis and I are the founders of Spartan Investment Group. We have built a company that's very values-based and has a very specific mission to improve lives to our values. And now we're a team of 130 plus people, and we've really built the portfolio and built a really great culture with Spartan being named one of the best places to work by Denver Business Journal. And we have a really strong backbone in the self-storage industry today, and our investors have really benefited from that.
Yeah, that's huge. And when you were making that decision to transition, what are some of the things that you looked at? I mean, you said why you chose what you did, but what was that process, and what were kind of some of the things that you eliminated to end up on self-storage?
Yeah, we looked at everything. We looked at multifamily, we looked at office, retail, things like that. But we started with defined criteria that had to meet what we wanted as operators. So that was and we came up with the easy to own, easy to evict, easy to maintain, the 3 E's. So if any asset class that didn't fit that mold, we didn't want to do. And then we were really attracted to self-storage because of its performance over the last 40 years. It's been the least foreclosed asset class out of all the other asset classes. And if you look at REIT data and performance, it's actually performed the best consistently over the last 40 years when compared to multi or office or retail or things like that. So those factors led us to think that our investment thesis should be self-storage. And we went through an entire education process many, many years ago where we were in residential, we understood that really well, and then we just stood everything down. We learned as much as we could about the industry. We went to the trade shows, we met with the top operators, we met with other partners in the space, and then just really got to work on building out a platform.
Yeah. As you were building out the platform, were you ever wondering, like, will this work, or are we doing this right, and all those sort of things as you're encroaching a new asset class?
Yeah, I think what makes this a fun story is, obviously Spartan started, Scott and I were neighbors in Washington, D.C., literally next door neighbors. And the way that we met each other was, I'm a sales guy, and he's very strategic. He was in the military. He's a military vet, so American freedom. Anyway, we met in D.C. I was an airline pilot at the time, and getting into real estate. One day he was walking down the street, and it was a house for sale the next door down. I was always pretending to check my mailbox whenever somebody walked by, so I could strike up a conversation and sell them on the house. Well, Scott was the sucker, and I sold him on the house. And then he sold me on starting a business together. So I guess I was the loser in that, but for better or for worse. So that's how we started Spartan. And, we didn't have any self-storage experience. We didn't have any much experience in real estate. So I think the lessons learned along the way is, if you're going to do this, I get asked all the time, business professionals in the industry and otherwise, they say, hey, Ryan, what do I need to do to get started? And I said, you're the entrepreneur. That person is, you're the entrepreneur. You're the visionary. You're the capital raiser. You're kind of the person who's going to be doing the whole thing. Whatever niche you decide to go into, you should go and try to find somebody in that industry who's not on the real estate circuit, not somebody going to like the best ever conference, or otherwise go look at Extra Space, or go look at CubeSmart, or go look at one of the REITs and find like an asset manager or a VP of the portfolio or whatever, and try to court them so that you can attract somebody who is highly experienced and technically proficient to do whatever vertical that you've decided to do. The hard way to do it is to just figure it all out on your own as you go. And that's basically what we did. Now, we've been successful at it, but I think a much faster path to success and scale is to find an industry expert and convince them to come work with you, somebody who may not have a portfolio. And you might have to trade some equity or or give up some salary if you got the cash, or a balance of both. And that's how we've been so successful in our construction company, is we went and found a 20-year veteran building industrial for a bigger company, brought him in as a president. That has absolutely just blown up our construction team. And we just named a president of our free up storage national brand, Don Matias, who actually lives in Salt Lake City and used to work for Extra Space. And so as Spartan looks to the future, our 3-year strategic plan is not just to be self-storage. We want other verticals. And when we do that, we're going to find experts within those verticals and bring them in early so that they can build out respective companies that Spartan invests
with.
It seems like this is a theme with a lot of our guests recently, is it's who, not how, right?
Yes.
It's finding that the right person rather than how to do it. You did do it, what you say is the hard way in the beginning. What were some of those challenges that you ran into in the beginning that you feel like you wouldn't have seen if you would have went the faster route, like you say?
Yeah, I think experimental marketing at the properties, what's the best way to drive, foot traffic? As someone who's worked for Extra Space or Cube or Public's going to know those things. The next thing is, staffing at the property levels. How much staff is too much staff, and what unique product offering should we have? Revenue management is massively important. So, existing customer rent increases, the timing, the amount, how to roll that out. We have a facility that we buy that's 97% occupied. How much should we raise and by how much and at what interval? It was all very experimental as we were going through that. Now we benefited, we were successful doing it, but I think having somebody who knows the space and is most importantly aligned with your company, right? If you can go hire one of these REITs, you can go hire a third party, but they're going to take all of your insurance revenue, right? We sell tenant insurance, Extra Space will take all of it. Right. And they're in it for Extra Space, or they're in it for, this isn't a bash on any particular company, but there's not alignment with that. So I think you get the benefit by doing it yourself. You can kind of go along the way, but you'll stumble a little bit because you're not speaking from 20 years of experience for a company that's competing at a high level. You're kind of speaking it from what you can find and what you can learn. And it's a big learning curve. And so I think that was really the struggle, is just some of the dropped opportunities, maybe building that brand. Now we did it and we got to the point where we're at. So, but there's a lot of lessons learned on there. And I think you can just go bigger, faster, better if you have that person who's niche-y in the industry.
So it sounds a lot like it's more about optimizing and being able to go further, faster. Was there anything that happened that really was like you felt like you kind of stepped in the mud, so to speak, and you go back and look at it and you relate that as one of your biggest learning lessons?
Yeah, I mean, we grew fast, and I love Simon Sinek's approach on this. He's like, it's not important to grow. Like growth for a company is like there's nothing. It's exciting and it's fun, and people want to be part of a growing company. They don't want to be part of a dying company. So it's really good for employee attraction and retention. We've been named the fastest growing real estate company for the last 3 years in a row by Inc. 500. We've actually, this year, we were ranked as the 4th fastest growing private real estate company in America. So really fun, right? But, as you grow, you need to have that experience on the team. And I think, it's, for somebody starting out, they might think, well, I don't have any money, right? So how can I bring in the best team without the money? So I think we did it really well, but it was a little bit bootstrapped in that as we created the money in the organization, we reinvested it into good people. But we stepped in the mud. I mean, of course. I mean, we bought a lot of assets in 2021, and it's taken us a little time to get our arms around some of those bigger portfolios that we've purchased, and we've learned a ton from that. And some of it our fault, some of it the assets were victim of circumstance, but I think that those lessons are why we've really been on a big push to bring in the expertise. And I think, judge me not how we did, but what we're doing now, right? And I think that's kind of how we're pivoting, is we're bringing in, really top level staff to fix a lot of the things that are in our portfolio that could be operating a lot better.
So Ryan, you're launching the construction side of your business. So you're going to be building for other operators, which sounds a little counterintuitive that you're going to be doing this essentially for your competitors. What made you make that decision to go that route?
Yeah, so I think part of having a world-class team that you can continue to feed and give revenue to, you want to be able to sustain that team and grow it and make it even stronger. And the reality is we can't just give them projects for the sake of giving them projects to keep them afloat, right? So we started the construction company for Spartan internally to just service our assets, to just build what we're doing as a risk mitigation strategy, because now we own the value chain. When we decide to pivot externally and offer this to other operators, we don't really view that as competition necessarily. Collaboration beats competition every time. It actually opened up a lot of opportunities for us, because now when we're talking to sellers of properties or we're talking to somebody in the market, we have more to offer. And so that actually opens up more partnership opportunities, which, feeds the Spartan machine a little bit more, not to mention the revenue, and then being able to keep that construction team strong and intact. Lastly, the more metal we buy, the more materials we order, the more markets we're in, makes it more efficient. We can get really good economies of scale with the construction company by building for other people as well. So multifaceted benefits in that, not just a singular thing.
How many markets are you in?
So we have facilities in 11 states. I don't know how many markets that is off the top of my head, but we're across 11 states. So our largest concentration of assets is in and surrounding the DFW Metroplex. We're the largest operator in Tyler, Texas, which is just to the east. Longview, Texas, and then our second concentration is in Georgia, but primarily we're in Florida, Georgia, Tennessee, Texas, and then we have a smattering of properties in the Pacific Northwest, just outside of Seattle, just outside of Portland. We like those bedroom communities. We don't like to be in the core. We like to be kind of out. And then we have properties in Wisconsin, Colorado, North Carolina, Kentucky, and Arkansas. And more to come. Yep.
So it makes sense what you said of helping other operators, because really that collaboration, and you're kind of front line if those people ever want to sell, right?
Yep.
There's the potential, they're built properly because you're the ones who built them. And it actually reminds me of the story of the corn farmer who had the best corn, and he was always giving out his next batch to all of the people around him. And everybody thought, how are you winning these competitions if you're giving away your best seeds to everybody around you? And he said, well, this is an ecosystem. And if there's bad corn around me, then the bees are going to bring it over to my crops. I want to have all of the best crops around me.
It's a great story.
Kind of sounds like you're surrounding yourself with great crops, so to speak.
Yep.
And with that, you're also feeding them on the debt side of things. It's something that I'm guessing that you've mastered, and now you're starting to find debt for other people and helping them with their own capital raises. Can you talk a little bit about that?
Yeah, so for those that are in multifamily has got a world of options for debt, because we can't, in storage, the only government debt that we can get is SBA. So we can't get the Fannie Freddie backed loans. So self-storage is very difficult to finance compared to other asset classes, because usually it's a smaller loan in a hyper-local market, and usually as an operator, if you're really scaling, you're going to be out of state. So when we find a property, we start looking for lenders. There's tons of objections, and it's a pretty lengthy process to find the right rate and terms for that asset. So when we go into a market, we've got to find the right lenders regionally, nationally, for wherever we're going. Now we have the United States mapped. We know if there's an operator who is in Georgia or Florida or Washington, we know and they have a value add, or maybe it's just a stabilized asset, or it's a ground up construction. We have lenders now everywhere where we know we can meet their needs, and we know that, okay, that's a loan for this bank. We'll call that bank. We just know we have the relationships. So similar to the construction side, we have an entire capital advisory team within Spartan. That's all they focus on: banking relationships, finding new loans. So what we do for other operators is we actually will provide them service to help them find debt on the asset. And what's so great about that is it keeps us in the game, because now we're talking to more lenders, we're talking to more relationships. Now we're doing a bigger book of business with a bank. And that means that that bigger book of business is going to benefit us at some point. It'll also benefit the people that we're doing the work for. Not to mention, we charge about a 1% fee on any loan amount that we get, like a traditional brokerage would. So it's just building up the armor of what we have to make us better at what we do for our investors, and then also help be a collaborative environment. And then if you layer that on to helping sellers or buyers, with debt, it again kind of makes us even more relevant.
Yeah, that makes a lot of sense. Can you help people understand what is a typical breakdown of a debt structure on a value add versus a stabilized asset? I think that would be really valuable for people to understand if they're looking to get into self-storage.
Yeah, you're going to be looking at typically 60 to 65% loan to cost on an asset. So if you're building a facility, if you're buying an existing facility that has some expansion, you're going to get about 60 to 65% leverage. Maybe you might get 70. In today's world with rising interest rates, the DSCR is really going to be your thorn in your side, because if the interest rate's higher, the leverage could be higher, but you're going to get throttled by your going in DSCR on an asset. So I would say generally 60 to 65%. Maybe in today's world, it's going to drop into the 50s because of DSCR coverage. But, and usually you're going to get some kind of a purchase loan with a construction draw to add on your additional storage facilities. Or some lenders might say, I understand that you want to fix this property up. So they might do all your draws at funding because they don't want to deal with, $200,000 to $1 million of paint, cameras, drive aisles, fencing, and they might just fund it all at closing, or they might put you on a draw as those improvements are made to the property. If you're just, straight down the middle, buying an existing asset that's a core plus, really nice property, you're still looking at 60, 65% leverage, maybe a little bit higher than that. And, you're looking usually at a 5-year term, fixed interest rate debt typically. But ground up construction, that one's a little bit more of a unicorn lender to find. They're going to want to see, the runway for lease up and interest reserves and all that stuff. Pretty typical though, pretty similar to that 60, 65% leverage. And, they're just going to want to see more stuff, right? They want to see a little bit more tighter underwriting. They're going to want to see more of a feasibility study. Obviously, there's a lot more due diligence that goes into a ground up site, geotech, environmental, phase 1, et cetera. But that kind of a deal would be still similar leverage, maybe a little bit higher interest rate and a little bit more difficult to find. They're going to, I always like to say it's eye of the tiger, right? They're going to look into the sponsor and make sure that the sponsor has the eye of the tiger, someone who can fight through an entitlement issue or somebody who has the chops to build a big property. They're going to, they're really going to vet the sponsor or the operator, the owner, a little bit more closely.
Yeah, and this could easily change by the time we even release this video. But what are you seeing in DSCR right now? And for people that don't understand what DSCR, if it's a 1-to-1 ratio, if you're bringing in, or if your debt coverage is $100,000, for example, then you need $100,000 in revenue. If it's 1.2 to 1, then you need $120,000 in revenue. What are you seeing as far as DSCR right now?
Yeah, so on a trailing 12 or a trailing 1 or a trailing 3, banks typically like to, of yesteryear, they like to see 1.2 to 1.25. Now it's going into 1.3, 1.35 and increasing. So banks are getting tighter. They want to see better DSCR coverage, and then your proceeds or how much loan you're going to get is going to get throttled by your DSCR requirements being 1.35 and then that being at a higher interest rate. So it's really going to push you down into like the 40, 50% leverage range, which if you're an investor, that's less risk because you have less debt on the property. So it's a pro to the investor, but the property needs more equity to close. So it's a balancing act. You're trading off some risk for some potential reward.
And with you seeing a lot of different operators out there, are you seeing these guys that started in a ground up construction now having to do cash calls or look for different money?
I just got off the Best Ever conference, and I think the theme of the entire event was we're stopping distributions and get ready for a cash call or a capital call. Or, there's some uncertainty, right? Because I think I'm an investor in multifamily, and I think one of the biggest surprises for me was that I never really wasn't super familiar as a passive investor that this was that there were floating rate loans. And I think a lot of them have now come to that extreme interest rate, and a lot of distributions are getting cut off. On the storage side, I'm not as familiar with the syndicator space because it's so small. So in all of our debt, with the exception of one loan, is fixed. So we're seeing these, when we talk about interest rate caps and all that, I mean, sure, we can get floating loans in storage, that's a thing, but all of our stuff is fixed rate debt. So we don't have any interest rate caps. We don't have any issues with our fixed rate debt. We do have a variable rate debt on one asset, and that deal has turned off distributions. It doesn't have distributions as the debt goes up, but all the other ones that have fixed rate debt are distributing just fine.
So Ryan, as you see sponsors at the end of the 5 years or have additional needs for capital due to the changing market, be sure to send them over to PREIshare.
Okay, sounds great. Yeah, that sounds like a great relationship because we're going to be in touch with a lot of those folks with our capital advisory. So definitely sounds like an excellent service. So thank you for that.
So Ryan, with you doing your raises right now, what is your typical process, and are you weighting it the same way that you just explained, or are you a little bit more heavily weighted on having investor capital so you have less debt? Yeah,
so we have 3 funds this year. We have an income fund, which focuses on cash flow, upside, and depreciation. So existing facilities that produce cash flow day one for our investors. Then we have a growth fund that is strictly ground up development. And then we have a debt fund. So that debt fund can actually service our own assets. So if an investor has, some investors say, I want to replace my hard-earned active income and be passive, that's great for the income fund. If somebody's like, yeah, I've got my income, I just really want to be in ground up development, get a little bit more risk, but also get the better reward, that's with the growth fund. So the way that we're structuring those two funds is we're raising $180 million this year, 75 million for the income, 45 million for the growth, 60 million for the debt. And our plan for existing purchases so far has been to buy them cash. And so if we can find debt that makes sense, we'll put it on the property, but we're planning on buying these facilities with cash and then refinancing them out at a more opportune time. I don't want to get into interest rate predictions, but it looks pretty gray or pretty bad, pretty stormy for the rest of 2023 with the Fed meeting again in a week or so. We're anticipating a 50 basis point, 75 basis point increase. We think interest rates are going to be higher for longer, but at some point on maybe the backside of 2024, 2025, we see the SOFR curve predicting interest rates to drop pretty considerably. And so if that keeps up, it might be more advantageous to wait and then allow that cash flow to go to investors. But at a minimum, lower leverage or cash purchases.
Sense. And you've been in this for a good amount of time now, and you've had a lot of investors that have come through your doors or lent money with you, I should say, put money with you. And have you had people that have run into those circumstances where they need early cash out, and how do you usually address those concerns? Yeah,
so I'll just say that we're really upfront with our investors, and I know this is contrary to what you guys offer, which I think is a very unique service. We tell our investors their investments are illiquid. And that, don't make an investment that you can't obviously be okay with losing. And so we've really kind of managed expectations pretty well. So we haven't seen a lot of investors wanting to call the cash back. Of course, you have those investors who, forget that it's a 5-year deal and maybe they don't like the way it's going, so they want their cash back. But unfortunately, it's an illiquid investment. Sans your service. But that's typically it's been managed pretty well for the most part. We really haven't had too many. When COVID hit, we had some scares. When the COVID-19 pandemic rolled out, we had a lot of investors who did like short-term rentals, and they were just nervous. They kind of scrambled. Okay, where's all my money, and what do I have, and let's get on the phone call and things like that. But generally, the investors are pretty good with it being illiquid. Our debt fund does have a redemption period. We had a lockup period of either 90 days or 2 years. So there is some liquidity, but it's based on availability, right? And we're very disclosed in our PPM about, first come, first serve and based on availability. So that might be something we want to talk about with your service as well, is maybe helping us with that. So.
Yeah, and that's exactly what I was thinking is, you're not unlike most everybody that we talk to, and it makes sense why you would build it that way. We just want to come in and add an additional resource, which we hope would actually foster even better relationships than you're already building.
With the listing hub and the ability potentially for your investors to list their fractional shares should they ever need the funds, do you see that being as a added benefit that you could offer?
I do. I definitely want to talk to my syndication attorney, just being fully transparent. But yeah, I could see that being, obviously, listen, the private alts world that we're in and not being publicly traded is a disadvantage. And so I think when you think about investing in the stock market, publicly traded assets versus this privately traded space that we're in, there's a discount you get for being publicly traded in liquid, right? And then if you are doing these private alternative investing, you should expect a premium on your return because it's illiquid. I think providing a service or providing an opportunity to provide some liquidity is a game changer. And I think it could be very advantageous to anybody who's in this space because it's taking the benefits of private alternative investing, which generally does very well for the ultra wealthy, and mixing it with the ability to, have liquidity in the market.
Yeah, well, and we've talked to a lot of sponsors, and at first when we tell them what we're doing, it almost like takes them back for just a second, and they have to think about it like, well, this hasn't been offered in the marketplace. Like, is this legal or how would this work?
Yeah.
And then once they get to know a little bit more about what we're doing, then it's like, aha.
Yeah. Yeah, and I think the big thing for us is we don't want to open we don't want to have like a trading desk at Spartan, right? We're managing, liquidity and trading shares. So I think it's, as an external service, I think it'd be very beneficial.
Yeah. And of course, we come from a real estate background. So knowing that you go into the securities realm and the stock market, oftentimes it's littered with fees. And we want to avoid that, right? So we want to create the liquidity without adding a bunch of fees or people in the middle.
And we're not acting as a broker dealer. We have a listing hub. They can list their fractional shares on the listing hub and kind of see what happens from there.
So Ryan, you said you have big plans for Spartan moving forward. Talk to us about what the next, let's say, 5-year outlook looks like.
Yeah, so I will tell you the 3-year outlook because we actually just published our strategic plan. And you can go on our website, spartan-investors.com. You can download our strategic plan. We share that with all of our investors, and our strategic plan calls for by the end of 2025, we want to have a $5 billion portfolio. We want to do 1 private equity play. We want to have a net promoter score across all departments and all employees all the way to the customers, to the investors of a 52 or higher. And we want to be in one other asset class. So, and $1 billion in revenue. So that's kind of our roadmap for 2022 to 2023, I should say, to the end of 2025. And we set that strategic plan every 3 years. And our prior plan, we completely accomplished. As lofty as those goals sound, it really focuses the team on what's to come and what to expect and what we're all really focused on to get to that main goal. But our big, hairy, audacious goal, our BHAG, as they say, is to achieve wealth for every Spartan. And that means a lot of things to a lot of different people, and have 100,000 active investors. So that's where that's where our vision for the business is.
That's great. You talked about communication with your investors. I wonder if we could dive a little bit more into that. What are some of the things that you do to keep your passive investors informed about past, current, and future transactions?
Yeah, so we update our track record on a quarterly basis, and we provide pro forma versus actual financials in that. Our investors who are active in our deals, they get a communication on the first of every month, no matter what. We can't guarantee returns, but we can guarantee communication that hits the first of every month. You're going to see a trailing 12 P&L. You're going to see pictures of construction progress, or if there's any improvements being had to the property. You're going to get a narrative from me about what's happening at the asset, maybe a little market update on what's going on within the facility or within the area, and then anything that we have planned for the future. That comes out on the first of every month. We also do quarterly conference calls for our investors where we check in. We have kind of a live Q&A, or you can ask questions in advance. And then we put all of those communication plans in our operating agreements. So we guarantee, or we put in on the legal documents, that we're going to do those updates. So we're pretty serious about that. And I would say that we're industry leading on communications. And that's what we get. A lot of the feedback we get from investors is that you guys are the best communicators. So
in terms of just the current market conditions, and specifically within storage, since that's where you play, what are you seeing right now?
Yeah, so self-storage, being an uncorrelated asset class, is positioning itself, we're positioning ourselves for a potential downturn or a recession or whatever we might want to call it. And that's when self-storage really shines. And so over the last 3 years, Blackstone, Bill Gates, sovereign wealth funds, inland capital, there is so much money that has bought into self-storage. For example, Blackstone bought Simply Self-Storage for $1.2 billion because it wanted its own self-storage arm, right? It's its own self-storage division, and they've continued to buy tens of thousands of units. Bill Gates bought a quarter share of StoreMart. Public Storage has bought over $3.5 billion in self-storage over the last couple of years. So it's a market where new capital and existing capital is lining up to pounce and consolidate the industry, because 70% of the industry is mom and pop owned. So you're going to see more consolidation. If you read the Wall Street Journal about 2 weeks ago, Public Storage put in a takeover bid of Life Storage for $11 billion. 19% stock premium, and Life Storage actually turned it down. So there is a huge demand for product, and there's not a lot trading. So, we're seeing at the bidding table, we're seeing 3 to 4% cap rate for some of these assets. We just sold an asset for a 4.2% cap rate low quality facility in a very tertiary market. And we're seeing that cap rate, those cap rates really hold firm in the industry, and people willing to pay for the asset that's going to ride them out through the next potential downturn. So just about at the end of January, Prime Group announced a $2.5 billion storage fund. That's the largest self-storage fund ever assembled in the industry to go out and buy assets. And that was backed by pension and endowment funds. So much money getting ready to go to war and self-storage and buy stuff. So having said that, the REITs are asleep right now. They're not even buying anything. So when you think about, public storage is bid, okay, fine. But like the capital that keeps infusing in the industry is mostly, smaller, maybe private REITs or non-public REITs and operators like Spartan who are really trying to get their hands on the product. So it's a very well-capitalized industry right now. And I expect it to be that way, as we go through through this, cycle.
So as Spartans, how do you plan to approach that battle?
Well, this year we built our ground up fund. And I think, I think every operator who's a syndicator or operating at the non-institutional level or doesn't have, super efficient capital is probably wondering the same thing. If there's no opportunities trading right now and the interest rates are what they are, how am I even going to find margin? And so we think that the most value is built from the ground up. We find really, really well located land that has a lot of entitlement work to do that we're experts in, and we can build that from the ground up. I think it's a tremendous time to do that. I think as people stop and they run into issues or labor issues, things like that we have in control, we can really build at low leverage ground up developments and have those products coming online in markets that have high demand. On the income side, on the income fund side of things, finding existing product is going to be hard this year. We have a goal to buy $240 million, and we're aggressively putting out offers every single day on properties. But the reality is we're going to face headwinds finding properties that fit our criteria. So I think it's going to be a challenging year for acquisitions of existing facilities.
Got it. What advice would you give to somebody who's trying to enter that space?
I would say make sure that you do education for effective action. I would go to all the trade shows, ISS, SSA, learn who the players are, learn about the space, and do it in a way that you can take action. If you want to take a mastermind or a course, there's not one place to go. I think when you educate yourself on a space, there's a lot of a la carte options. If you want to learn underwriting, there's a course for that. If you want to go to the trade show, there's certain things you take away from that. If you want to join a group, there's a lot of self-storage educational groups out there that you can join. But all those pieces put together can make somebody who has a familiarity with the industry to know what they're really getting into and how to navigate it. So I would say, education for effective action, and don't just have a one-stop shop for it, kind of look around and do bits and pieces.
Is there any final thoughts that you would love to leave with our audience?
No, just really looking forward to 2023 and appreciate you having me on to talk about self-storage.
Well, Ryan, thanks for joining us. And for those of you that are watching right now, if you'd like to see other full-length interviews that we have done, go to our YouTube channel. And if you are interested in joining our community online that has investors and sponsors, go to PREIshare community.com, and we'll see you on our next episode of the Syndication Show.